By May 2026, the streets of Chattagram's commercial hub became the epicenter of a financial blockade. Depositors physically locked down 5 major Islamic bank branches, forcing staff out of the offices. They demanded the immediate return of trapped funds and the absolute cancellation of a regulatory policy they called a haircut. This data map illustrates the systemic scale of the freeze. We are looking at 7.6 million individual accounts and over 1.42 lakh crore taka in restricted deposits. These protests are the terminal phase of a forced consolidation. Regulators merged 5 failing Sharia-compliant institutions into a single state-owned entity named Sammilito Islami Bank. To understand how millions of accounts were frozen, we have to look at the insider lending that mathematically inverted the bank's balance sheets, and the specific theological doctrine regulators used to engineer a multi-billion-dollar bail-in. The Sammilito merger is a high-stakes attempt to resolve a collapse. It tests whether a central bank can use religious principles to plug a massive capital hole created by corporate fraud, raising immediate questions about who actually pays for a bank's failure. The cleanup of the banking sector began at the Bangladesh Bank headquarters in Motijil. This side-by-side chart visualizes the combined pre-merger balance sheet of the 5 Islamic banks. Total deposits stood at roughly 1,036,000 crore taka. Total loans reached 1,095,000 crore. This represents a mathematically inverted balance sheet. The banks loaned out nearly 60,000 crore taka more than they held in deposits. This deficit is the direct result of governance capture. The Islamic group systematically controlled these institutions, stacking boards and overriding risk protocols to authorize massive related party lending. Through a network of anonymous shell entities and insider channels, the Islamic group extracted approximately 30,000 crore taka from the banks they controlled. The true severity of this capital flight was concealed under layers of falsified reporting, until asset quality reviews conducted by KPMG and EY audited the books. This technical document shows the actual non-performing loan ratios discovered by the audit. The review found that 98, acting under the Bank Resolution Act 2026, the government injected 20,000 crore taka of fresh capital to form the new Sammilito Islami Bank. Regulators turned to a foundational concept in Islamic finance, mudaraba. This flowchart maps the contract. Instead of fixed interest, depositors share in business profits generated by bank investments. By definition, this has an inverse. If the bank registers massive losses, the depositor is entitled to zero profit. In January 2026, Bangladesh Bank issued a directive utilizing this specific theological technicality. They formally declared that all 5 banks had run at a massive loss. Regulators applied a retroactive recalculation parameter, ordering that all depositor balances be reset strictly to their figures from December 28, 2025. This calculation executed a severe haircut on millions of accounts, completely wiping out 2 years of accrued depositor profits for 2024 and 2025. The regulatory justification relied on the premise of standard market loss. The reality of the balance sheet was corporate embezzlement. Bangladesh Bank successfully engineered a multi-billion-dollar liability reduction, applying a religious doctrine intended for market risk to legally cover systemic theft. This maneuver triggered immediate theological pushback. The Central Sharia Board intervened, formally challenging the regulator's application of mudaraba. The board argued that while mudaraba requires depositors to share legitimate business risk, it cannot be invoked to force everyday savers to bear the burden of management fraud. Facing intense pressure, Bangladesh Bank partially retreated. They shifted from a strict zero-profit rule to offering a 4% ex gratia payment for the 2 lost years. Even with this 4% concession, the massive liquidity gap means physical withdrawals remain heavily restricted. This pie chart visualizes how regulators structured the depositor protection tiers, splitting account access based on size. Balances under 2 lakh taka are fully protected and accessible. Anything above that threshold faces multi-year withdrawal freezes. Retail savers receive nominal protection, but institutional funds and lifelong savings are effectively trapped, devastating both corporate cash flow and individual wealth generation. This table compares the Bangladesh haircut to global banking crisis frameworks and IMF recommended structures. During the 2013 crisis in Cyprus, regulators executed a bail-in on uninsured deposits over €100,000, operating within a formally codified European Union directive. In Lebanon in 2020, the state allowed an informal, uncodified freeze, lacking structural transparency. Bangladesh sits in a difficult position. Lacking a functional deposit insurance scheme, their ad hoc resolution was complicated by unique Sharia compliance challenges. An IMF-compliant resolution relies on three structural pillars: a codified legal hierarchy, functional deposit insurance protecting small savers, and transparent recovery timelines. Because Bangladesh lacked pre-existing deposit protection infrastructure, their approach fails on all three counts. Managing a banking collapse ad hoc without a predefined legal hierarchy strips depositors of their contractual rights and elevates regulatory whims into sovereign law. The international market reacted sharply. Fitch Ratings downgraded Bangladesh's sovereign rating to B+ stable. Fitch issued an explicit warning: there is a total lack of global precedent for default resolution at Islamic banks, making the sector a highly volatile sovereign liability. The macro risk is contagion. If panic spreads to the remaining healthy Islamic banks, it threatens the stability of an entire financial sector currently carrying 6.44 lakh kur taka in total non-performing loans. This crisis inflicts severe psychological damage. Faith-motivated savers specifically chose Sharia-compliant institutions for religious reasons and are now being penalized through those exact doctrines. The Sammilito bail-in may have filled the 1.15 lakh kur capital hole, but by forcing depositors to absorb the losses of corporate fraud, regulators have left savers questioning if Sharia banking can still offer the security promised.